Hello and welcome to another episode from Aquarians Tutorials. So last time we have imported the data, now let's take a look at it. Let's examine some stocks. SPY looks okay. F looks okay. Just because a few stocks look okay doesn't mean they are all okay. You can have hundreds, thousands of underliers, so you need to have some automated method of checking them. So how to do that? We'll run a job, validate underlier job. So just enable it and run it. It's done and look for failed. So we have these underliers that don't look well. So let's take a look at these. Disable the job and restart the software in graphics mode. And let's open these stocks. Okay, so these are a few of the stocks with problems, essentially all the problems that it detects. So let's see, this one doesn't have enough data. We need a few years of data. This one also doesn't have enough data. This one has stale data. So from here to here, there seems to be no data. This one as well. So switch to points to see. So switch to points to see clearer that data is missing. This one also has missing data. And this one has weird jumps. So these sort of problems can appear in the data, and you just don't want to do backtests with these stocks because the results are faulty. So that's one of the things that data validation is doing. So first, just eliminate the underliers that have problems. Now let's take a look at the options data, which is a bazillion times more complicated than stocks and also has a lot more problems. So for now, just enable one single underlier and enable these flags. Normally they are set to true in order to validate the data, but we'll disable any sort of data validation to take a look at the raw data and how weird it can look. So start playing the data. So if you play the data, you essentially get day by day a view of how it looks. So let's reset and start from the beginning. And let's explain a bit what we have here. We see the options data. We have different terms. For each term, we see, like, let's say 2006, March 17. For each term, we see calls, bid and asks, and puts. We also have the implied volatility, which is calculated from the option prices, specifically from the out of the money options. So it's calculated from this side of calls and this side of puts. And let's select the same term on the volatility as well, March 17. It looks like this. It's a bit weird. And what we have also the implied forward. So we have the spot price, which is actually the close price of the stock. But when the option snapshot was taken, the price might have been different. And also it doesn't quite matter what the spot price is because options use the forward price, which is spot minus dividends. So if there are impending dividends, the forward will reflect that. So how do you calculate that forward? Well, it can be implied from the call put parity. We'll cover that later. So essentially, you can get the forward price, but by computing it implied from the stock prices. So we have the forward. Using that, you can calculate the implied volatility. And once you have the implied volatility, you can do valuation. So using Black-Scholes, more precisely using the Black model, because we are using the forward in order to not have to specify the dividends because they are implied in the forward. And you have values. And what we see here, we see in red if there's an arbitrage opportunity. There should be no arbitrage opportunities normally in the data, because in real life you don't see such a thing unless you're ultra high frequency. What is an arbitrage opportunity? Well, when the theoretical value, the fair value calculated using the implied volatility, is outside of the option bid ask. In that case, you can do a trade to arbitrage that. And so let's see such a thing like the fair value is 498, the option price is 5.1. So then you could sell the option at 5.1 and delta hedge the position to virtually buy it at 498. So you would make the difference, 0.1. At the moment, ignore other considerations like borrow costs and what else. So let's look at a term that has no such arbitrage, if there is such thing. Well, not really. And that's a problem because we should generally have the data without any sort of arbitrage situation. And let's move the date pointer to even worse looking data like this one. And this one, besides option arbitrage, so look at the volatility, it's totally weird. It also has parity, call put parity arbitrage, which definitely shouldn't exist in the data. So if you click on the strike, you can see how much money you would make trying to do a call put arbitrage. Normally it should be negative, so you couldn't do anything, any sort of arbitrage using the call put parity, but on some strikes, you could make a little bit of money, which, okay, let's say would be fair, but these huge values are totally out of place. They never exist. So why do they exist in this data? I have no idea. I suppose they just sampled it at different times. So I don't know, they sampled this part at some point in time, and then they sampled this one at a different point in time. So it's actually different forwards. So if we let the data like this, essentially you'll get random result. You'll get some totally irrelevant results in backtest. You cannot trust that. So you have to correct the data, otherwise you can't use it. This is what I'm going to cover in the next sections. So let's go back to the config, comment this, so we use the whole data. And at this time we won't run a job, we will run a strategy. It's not really a strategy, it's a data validation process. So it will run something that looks like strategies, but actually just analyzes the data and writes in the database the results. Uncomment this also. So in order to enable strategies, this has to be enabled. And this one is on each restart to automatically clear the results of previous strategies. It's handy to use it. So move this to continuous and click start. And you can see here how it's cycling through all the underliers and goes through all the day. So close the UI because it's slowing the processing a little bit. take a look at the log, just to make sure there are no problems. See that it's processing on 4 threads, like it's configured here, and we'll have to wait for it to complete. Okay, it completed. So what it does actually, it's calculating some statistics that you can use to watch the stocks. So let's take SPY, for instance. And you can check besides this, the statistics that it calculated, like parity arbitrage over time or option arbitrage over time. So let's stop the application and comment this so it doesn't reset the database when we restart the application, and take a look at the data. So you see that there's option arbitrage, parity arbitrage over time. So it calculates the maximum for each day over the whole terms and puts it in the database. So there are days, and it also limits it to like 100% annualized, because it could be like super huge, so it would distort the graph. So let's take a look like one of these days. I don't know, here. So on the 16th of March 2007. March 16. Restart the application and take a look at that respective day. Here it doesn't look good. Seems to be pretty big in this day. Okay, I found it. So it's on this term, and if I'm switching to parity, you see a huge $22 parity arbitrage here. So the prices look like this, and suddenly among in the money values appears an out of the money value. So this one definitely has nothing. It shouldn't be here because it's definitely faulty, and it's caught by these statistics. So overall, this is how it looks for, let's say, for SPY, and we also can collect sort of an aggregate for all stocks. So database, take this query and paste it here, remove the comments, and run it in PostgreSQL. So for SPY, we see that we have something like an average of 8% daily, which is huge. Others look just as bad. So what can we do to correct the data? So we'll cover this in the next section. Let's look at the data again on this particular day. One of the first problems with it is put-call parity arbitrage. So I'll discuss what that means. I have these documents in resources doc and a scanned document. So when you do a virtual buy of the stock, which you do by buying a call, selling a put. So this is a virtual position which has a delta of 1, similar to buying a stock. And then you make it delta neutral to selling the stock. So what is the P&L of this position? So you buy the call, you lose money. That's why minus here. How much money? The call price at moment 0. You sell the put, you make money. That's why plus. How much money? The put price at moment 0. You sell the stock, plus stock at moment 0. Time passes, goes to expiry, so time t. You have to close the position. So you bought the call, now you have to sell it. So you make money, that's why the plus. How much money? The call price at moment t, at expiry. You sold the put at inception, you buy it back at the end, so minus how much it costs at the time. Sold the stock at the beginning, buy it back at the end, minus. Now, depending on where the stock is at the end, above the option strike or below the option strike, the call and put could have different values. So it has these values for above strike and these for below. So you have two cases and you replace the P&L, profit and loss, for both cases. And in both cases, the stock price at expiry disappears. So you are left with the same formula, which you notice that it only depends on the prices now. So stock price now, call price now, and put price now. You also have to consider interest and borrow. So when you short the stock, you will have to pay borrow rate to the broker, which is around 2% above interest rate. So there's also you're losing some money in the amount of this. So the overall P&L is fixed at inception and it's the stock price at now minus the ask price of the call because you buy it, plus the bid price of the put because you're selling at bid, minus borrow. In case you do the opposite trades, so a virtual short of the stock, and you actually buy the stock to neutralize the position, you have this formula for the P&L. Overall, the P&L for buy is this, and the P&L for sell is this. So under normal market circumstances, this P&L would be negative. There would be no opportunity for making money. So there's two P&Ls. I'm showing here the highest, which is still negative. So you cannot, either if you try to buy or sell, you won't make money. So normally it should be negative. And if you solve the inequation, it results that for buy, the stock needs to be, there's an upper bound for the stock. If the stock is higher than this, then there's an arbitrage opportunity, which means the stock will be below this. And for shorting, for short selling the option, the call, you have a lower bound for the stock. If the stock is lower than this, there will be an arbitrage, but it should be here. So the intersection of these two regions, of these two regions gives the non-arbitrage region. So the stock can be anywhere here. Replace stock with forward. If you have dividends, you actually have stock minus dividends. So S is actually an F, like here. So you have F. And in the middle of this, you have this formula. Call minus put plus strike. Call minus put plus strike equals the forward. Discount is usually around 1. So you can take the implied forward. So if you have option prices with full spread on both bid and ask, you can take this formula for the forward, one for buy, one for sell, and get different values for the forward, and I'm taking just an average of whatever I'm getting to calculate this thing. So this is the forward implied from option prices. And from that on, I'm using these formulas for PNL to figure out if there is some opportunity. And there should be none. Here they are huge, and how to get rid of them. So this is the question. Well, there are 3 flags that control. They're all normally set. This one is true, set to true. And how many forwards to consider when you're calculating the implied forward, you have to have at least 3 forwards around the money which have no parity arbitrage problems in order to consider the forward correct. Otherwise, just discard it. So let's take a look at the algorithm, which is validate prices. And what it does, well, it does several things. The first thing, it tries to find the longest monotone sequence of prices. So if you notice, the prices should be monotone in one direction or the other. Calls decrease with increasing strikes. Puts decrease with decreasing strike. So they normally should be decreasing or at monotone in one direction. So let's take a look here. 0.9, 0.16, it's increasing, and suddenly here it decreases. Then increases again. So this one, it's clearly faulty. Then you have increasing, here again is decreasing. So if you apply the algorithm to find the longest monotone sequence, then these values that don't belong will be eliminated. And let's see what we get if we enable that. So enable validate prices. Okay, but uncomment this second pass because I'll discuss it later and see how it looks now. Well, we got rid of no, this was October 17 or the first time. I think it was the first time. Yes, the first one. Yeah, so it looks much better, the volatility, but it's still not perfect. And there are still, let's see, there are still parity arbitrage problems. Lower here, but here they are quite big. So we got rid of that weird spike in the volatility, implied volatility, but still we have a lot of problems. And for that, we have the second part of the algorithm, and that it's looking, so first thing we have eliminated. We're sure that we have monotone sequences for the prices, and now we have calculated a forward without considering faulty values, because before that we could calculate a forward using faulty values. And now we take a look at the extrinsic values. What is the extrinsic values? Well, for out of the money options, extrinsic value it's actually the option value. It doesn't have any intrinsic value. For in the money options, it's the option value from which you subtract the difference between strike price and the spot. And by clicking on the column, I am showing the extrinsic values. And the extrinsic values, again, should be not monotone. They should be decreasing as you move away from the at the money. So let's take a look. 0.8, 0.6, 0.5. So they are decreasing. And suddenly they are increasing here. So they decrease up to here, and then they increase. some bit and then they increase a lot. So you notice that the first pass did something, but it didn't do anything for these extrinsic values. So we also have to eliminate that. So the second pass of the algorithm will make sure that the extrinsic values are always decreasing. So at the point where they start increasing, they eliminate anything beyond that. So let's enable that second pass as well, which is enabled by default. Just wanted to show you how it works. So restart. Take a look at the graph and it looks much better. The parity problems are almost eliminated. These ones are rather small. Now, when we are looking at some opportunity, like parity, put call parity, I discussed here that we also have the borrow cost. So in order to consider the borrow cost, enable put borrow factor 1, and I set the borrow rate to 0.02. The interest rate is read from a file. So it will only consider those arbitrage opportunities that exceed this borrow cost. It helps a little bit. But in this case, they are higher than the borrow cost. But for other terms, the other terms look pretty good. So they don't have any arbitrage at all on them. What we still have, a lot of terms that have no, so they only have one side, like puts, and don't have call liquidity, or only have liquidity like ask and no bids. So this is debatable, but I'm ignoring them. And for that, I'm also having this validate spread, which only considers the strikes that have full spread. Let's take a look again, and it looks much better. So the strikes, we are only looking now at strikes that have enough liquidity on both sides. And notice that all the terms are almost perfect, so no arbitrage at all, except for the very first term, which seems always to be the one causing trouble, especially when it's approaching expiry. Let's take a look at another date. So December 14. Well, the higher terms are okay. No arbitrage on them. But the first term is having problems, having quite a big parity arbitrage problem. And for that, I'm also enabling this forward validation. It requires to have either to be arbitrage free or to have at least 3 strikes with no arbitrage on them in order to be considered. So let's take a look again. So what you noticed is that it fails to compute a forward, so it fails to compute any value. So it just throws its hands up and says this term is unusual. So no, not considered. How about the next one? Everything was eliminated. And the next, it's perfectly fine. So It won't consider in calculations the terms that have unreliable data. So this is pretty much it, what it's done. So all these are enabled by default. So then we can calculate the statistics again for the data. Like continuous. Don't forget to enable this auto trade. So recalculate the statistics, this time with fully validated data. So all these are enabled by default. Calculate. And I'll just stop it and show recorded results because it takes some time, and see the difference between raw data and validated data. Okay, so this was the original aggregated query, and running another one on the validated data, we can see the difference. So from around an average of 8.3% daily, it has the maximum arbitrage, parity arbitrage, no, option arbitrage that was found. It was reduced to 0.6%, so almost more than 10 times. And let's take a look at how individual values look for just for SPY. So this was the raw data with a lot of spikes, parity arbitrage in the 50, 100% and above. And now we have the highest around 20%, and what we get is around 10%. And for options, it's about the same. So it didn't completely eliminate all the faults, but data is mostly arbitrage free. And in the backtests, I will ignore anything that has an arbitrage problem. I found one of them here. Where is it? There was a red. Well, yeah, like this. So it's rather small, 2.2 compared to 2, always on short maturities. The longer ones don't have this problem, but the data now, it's clean enough to be usable and to be trusted in backtests. So this is the point that I wanted to emphasize in this chapter. So we have the original data, which is pretty much unusable, but after applying the correction and validation algorithms, actually validations to just eliminate data that it's spooky, then what we are left with is perfectly usable. And we'll start using it in actual trading strategy backtests from next time. Thank you. See you next time.